For information, the all-time low of crash 1000 was recorded today in the history of crash 1000. This is the lowest point it has ever reached in its history as of the time I'm making this video. Well, it may break that point, but as it stands, this is the all-time lowest point on the crash 1000 market, which is around 9189.4. So this is just for your information. I don't know what's going to happen in the future, but today we are talking about moving averages. Although we have the simple, exponential, linear, smooth, weighted and all that, we are focusing on simple and then exponential moving averages. And the simple moving averages shows the lines on the chart based on the calculation of the average price. So it's more like having 100, 90, 80, 180, and then you find the average of those five, you get 90. Right, so your average will be moving at 90. You'll be moving at the mean of 90 because it's just simple moving average. But the exponential will take into account the weights of the recent prices to make it more reactive to price action. So the exponential changes faster to account for recent price action. So although if I add my orange as my exponential and I add my my simple, the same 5 and simple, and I change this to maybe purple, although the purple, which is a simple moving average, seems to join the candles faster than the exponential is taking into account the weight of the recent price action. So exponential tends to take time to think. That's how I can explain it in simple terms. It takes time to think. So it's not just going to join these candles and say, okay, moving average is here, but it's going to wait. It's going to wait in order to weigh the prices or the price action before it enters the candle zone. So it doesn't just move like that with a simple. Moving averages, let me say, they are not the holy grail, but they help you to capture the trends. So today I'm going to talk about a few of the moving averages and what they represent. I'm Danny Legend and welcome to Boom and Crash Expert Advisor. To start, I'm going to insert my 5-day exponential moving average, and this exponential moving average helps us to find the trend of the market on the daily time frame, and then it acts as support and resistance. So if I should do this, I should maintain everything and I switch to exponential, the 5-0 exponential. This, when we do this, it tends to give us support and resistance of the market. But if I'm on M1, I'm not going to see it. But if I switch to the daily time frame, you'd see that the 5 exponential moving average gives us the support and resistance. So I'm on the daily, so it actually finds support and resistance on the daily time frame. Even though you like to scalp and you're not focusing on daily time frames and all that, it still can help you to know that we are still hovering over a support or we are beneath a resistance. For instance, when you look at this, you find out that the 5 has created a support on the base of these candles, although it's not a straight line because the market is not perfect. It's perfectly imperfect. You find out that we have the 5 EMA acting as a support on the daily time frame, and when the support is broken, it acts as a resistance where all the candles or most of the candles are found underneath the resistance. So 5 EMA serves as support and resistance on the daily time frame. So if I come here and I see that the candles are above my support, which is my 5 EMA, I know I'm in a buy zone. I should be buying here until I see a break, and then I know I have to start selling. So it's telling us that the current movement or the current trend of the market is below the resistance. So very soon it's going to cross the resistance and it starts to buy. So that's the 5 EMA. So remember that shorter time frames, the shorter the time frame, the more prices are subject to noise, and then there is random nature of buyers and sellers. So although this one is computer generated, it still acts like the real market, and then we have buyers and sellers. If you use the other was it support and resistance indicator, it's going to tell their buyers, going to tell their sellers, and all that. So this is pattern after the real market, and there are buyers and sellers, and it's pattern after the random nature of buyers and sellers. Let me put it that way. Then the higher you go on the time frame, the more you see the trends and then the patterns of accumulation and distribution of a market, and these things get closer to key moving averages. Right, so let's look at the 10 moving averages. I'll insert this trend moving average, and I'll make this 10. Now change this to something we can all see. So Dodger blue, yes, and then the 5 tells us there's a break here. 5 tells us we are below a resistance, or resistance has started to form. But the 10 confirms later on. So after the 10 confirmation, at this point 5 is telling you are in a resistance, 10 is telling you we are now in the resistance zone. So it's 10 tends to keep you on the right side of the market. It's a signal in the market that there's a trend that is strong in one direction. That's what a 10 stands for. Then we take a look at the 21. I'll insert 21 moving average, and I'll make this dark orange, or orange, this 21. So 21 is the line to which the most pullbacks reverse. So if we have this one, we have a trend going upward, then we see a reversal here, then there's a consolidation for 4 days before there's a downtrend. So it's the line to which most retracements occur. You see there's a break here, and then there's a pullback here, and then it breaks it a little, goes back up. So it's the line for most pullbacks. There's a downtrend here, pulls back up to the 21, and then goes down again. So it's more like it's one of the waves. If you are looking at Elliott waves, it's one of the points at which the market always moves from. So if this is 1, 2, 3, you find out that this is 2.2, and 0.2 is on 21. It's within the zone. It's not a particular price point. It's within this zone. It's within this zone. Okay, then the 50, we have the 50, and I'll make this red. We don't have red, so I'll make this red. The 50, I'm going to explain it in terms of bull markets. So bull markets pull back to this level. When there's always a buy, it's going to pull back to the 50 level in most instances, not always the case. We call it the buy the dip level. So if you have a bullish market, so at this point you see that it breaks the 50, which is our red. Okay, but in a bullish market, for instance, this point, you realize that as the market trended this way, I'm still on day 1, that is D1, the daily time frame. As the market trended upward, it pulled back and did what? And it hit the 50 level here. So this is what? Buy the dip. This is the buy the dip level, which is the 50 S. Let's make it, this is supposed to be SMA. This is supposed to be SMA. So that is buy the dip zone. So 50 SMA. So the first 3, 5, 10, 21 are exponential moving averages, and then 100, 200 and 50 are simple moving average. The simple moving average of 50 is the buy the dip level that you see here. So in a bull market, when it retraces, you should be targeting 50 as your buy the dip level. You should be targeting 50 as your buy the dip level. And when the 50 is broken from here, your next target is the 100. Your next target is 100. I'm going to set this as green. We don't have green, so I'm setting this as green. So if 50 is broken, the next target is 100, which is here. You can see it here. So at this point is also what, buy the dip, but then this is the buy the dip that is at the 100 level. So the 100 provides a support between the 50 and the 200 day SMA. So if the 100 doesn't hold as a support or a resistance, then there's a high probability that the next stop is 200. So I'll set this as green. So this is another buy the dip because 50 was broken, so this is the target. 50 was broken, so this is the target. Do you see that? Good. Then we have our 200. Now set this to almighty black. So if 50 is broken and 100 is broken, the next stop is what? Is 200, which you see here, buy the dip. Set it to black. Do you see that? So the 200 has longer term support and resistance, and this line is one of the biggest signals in the market, and it tells you which side of the market you should be on. So if it's very wide, so if the market has all the candles or almost all the candles above the 200, which is the black, then we know we are supposed to be buying. And when it crosses below, we are in a sell zone. So this is a wide range support and resistance. So beginning from 5, which was small, we see that the 200 gives us a broader view of whether the market is buying or is selling. So it starts here because that is where the 200 starts from. So this is what makes you understand moving averages, that at this point we could now account for the past 200 days. That's why the 200 moving average didn't start from here. It had to wait for 200 days before it gets the first spot. So if the next day comes, then it will now account leaving the first candle and calculating from the second candle, which will add up to get 200. So it will always be moving till you have 200 candles within a particular period. Then it calculates how the line should form. And you see that as we go to the other lines, they get shorter or they get longer and longer till the first day. Right, so that's just about it for moving average. I would have to go deeper in this, but of course I'm going to start a mentorship program, and very soon I'll come out with the curriculum, the syllabus, for those interested to pay and then to learn deeply about these things that I teach. Thank you very much for watching, and bye.